All right, we are live. Welcome, everyone. My name is Bronson Hill. Welcome to the Inflation Strategy Summit, where we're going to talk about what is happening with inflation and, most importantly, what you should do about it. So we have a lot of things to talk about. Before we get into it, though, let me introduce our speakers, our panelists that are here. Really excited for this event tonight. If you're joining us live, just put in the chat where you're coming in from or what you're hoping to hear or who you're hoping to hear from. Just helps kind of get the chat going there as well. So we have Jason Hartman from jasonhartman.com. Welcome, Jason. Really excited to have you back.
Thanks, Bronson.
Yeah, really excited to have you. Russell Gray from the Real Estate Guys. Really excited to have you as well. We know we've done a number of these together. And we have Brien Lundin from the Jefferson Companies, as well as the New Orleans Investment Conference. So guys, we've got a lot to talk about. There's a lot happening here. Just for those that don't know me, my name is Bronson Hill. I run a company called Bronson Equity that we do multifamily real estate investing, helping people do passive investing through real estate. Okay, so with formalities aside, let's jump right into it. The question everyone's asking is, what's happening now, and really where are we headed? So to kick us off, let's start with Jason Hartman. Talk to us about the actual inflation rate, and where do you see that we're actually headed in the near future?
Well, predictions are worth the paper they're written on, maybe. But
I'll write it down.
for whatever it's worth, the government would like us to believe our inflation rate is around 8%. And I think all of us here on the panel, as well as many in the audience, will agree that we anecdotally and empirically from our daily lives know inflation is significantly higher than that. I say it's around 15%. But again, everybody has, of course, their own personal inflation rate depending on their spending patterns. So it varies for everybody. I think some of the inflation, to be fair to Chairman Powell and the others in his camp, some of it is transitory. However, I think there are significant and very real inflationary pressures in the system. In the last year or so, we saw the money supply increase, M2 money supply increase by about 26%. So just logically, we would think as that trickles through the system, inflation would closely track the money supply, right? But of course, it's not the only thing. There are other factors. I think the inflation is going to continue for a few years at least. And it'll be uneven, of course. It affects people differently. It transfers wealth from the poor and the middle class to the rich. It is a wealth transfer, and I think it's going to continue for a while, for better or worse.
Yeah, it is interesting. It really is a wealth transfer, and it does affect people differently, and especially the poor and middle class, where a lot of these handouts were really seeing, hey, we're going to give all these handouts and things to help people because of COVID. It actually ends up hurting the people that they said that they want to help, which is really unfortunate. And so it's a bit upsetting. But let's talk about a question that everybody's talking about. If you're blessed enough to own assets, or you desire to own assets, you typically can weather inflation better than those that don't own assets. So rates are rising. So everybody's concerned about this, particularly if you own something that is like real estate, where things have dramatically changed. In the last, I think it was in December, a 30-year fixed mortgage was 2.9%. A month ago, it was 3.9%. And this last week, it was 4.9%. So we've seen about a 74% increase in the interest rate, at least for mortgages. So Brien Lundin, talk to us a little bit about interest rates and asset prices. I know you write the Gold newsletter. Can you talk a little bit about just how it affects assets and commodities and kind of where you see things going from here?
Yeah, the Fed is raising rates for a reason. It's supposed to tamper down economic activity and excess, et cetera. Now, there's been a lot of excess, of course, in the housing and in real estate, and interest rates the housing market is particularly sensitive to interest rates, of course. So that's one of the immediate effects of that. And people tend to think that rising rates are going to affect gold negatively. It seems counterintuitive, but in fact, rising rates or a rising rate cycle by the Federal Reserve is actually bullish for gold. It has been over the last 4 times they've tried. And in particular, the last time they did it in December of 2015, gold popped right on almost to the day when the Fed raised rates. And then it went on an 8-month tear, gaining about 30%. And in that period, mining stocks more than doubled. Some of the junior mining stocks that we tend to play around with in Gold Newsletter went up as much as 5 times over during that period. So that's the easy analog right now in respect to gold and silver and the associated investments like mining stocks. That's the easy analog. We'll see if it plays out that simply. But I think it was getting ready to do that before we had the invasion of Ukraine, and that kind of just threw some noise into the signal for a while. But I think the markets have pretty much discounted that across the board. What they're not discounting are is the looming recession that the inversion in the yield curve seems to indicate. So, equities are going through their own rough patch right now, potentially a rough patch. But I think gold and silver are really poised for probably 6 months or more of a really good market.
Yeah. So I'm a big fan of gold and silver as well as real estate. That's our business, obviously. But right now, we feel like there's so many things that are changing. Things are changing very quickly. It's not just rates; it's things in the world. It's in economics. It's happening, of course, with the stuff in Ukraine. There's a lot of things that are happening. But Russell, why don't you talk to us a little bit about any one of your segments you do is called Clues in the News, and what are some things that you're kind of seeing these days that are really important that investors start paying attention to?
I had a chance to be on a panel. Brien graciously put me on a panel with a couple of really big-brained people at his last New Orleans investment conference. And the same comment I made there, I'll make now, which is the bond market. I think that most people don't pay any attention to the bond market. They don't understand the bond market. The news cycle is designed to drive everybody's attention and focus onto the stock market. The bond market is way bigger. Obviously, as real estate investors, we use debt. We care about interest rates. And so that is one reason why we pay attention to the bond market, but it's a whole lot bigger than that. The bond market is effectively the credit markets, and the flow of money from the printing presses to Main Street, whether or savers to Main Street, pretty much all work through the bond markets. And so when you see, say, for example, the 10-year, which is really the one you want to pay attention to, when you see that yield going up, that tells you that there's more risk in the system because interest rates are basically a risk premium on debt. Okay, so it's just like if your insurance rates go up, or if you have a credit card and you're borrowing and your interest rate goes up, it's usually because they think you're more risky or they think the credit markets are more risky, and so they want to make more profit. And so when you see those interest rates go up, that's one level of problem. The next level of problem, because obviously when the Fed is raising interest rates, they don't actually raise the interest rates, they raise their target, and it dictates their activities in the market. They're either a buyer, which would bid up the price of bonds and drive down the yield, or they're a seller, which means they're going to increase the supply and drive down the price of bonds and drive up the yield. And when you hear quantitative easing, they're a buyer. When you hear quantitative tightening, they're a seller. And so what you have to understand is that the yields have been so low on bonds for so long that the poker players in the casinos of Wall Street use massive leverage to magnify those minuscule gains. And the collateral they use are these bonds. And the problem when you use debt in the paper markets, unlike the real estate markets, is that when the collateral value drops, the price goes down, you get a margin call. That doesn't happen in real estate. If I buy a property for $100,000, I got an $80,000 loan, and the property drops in value at $80,000, I lose my equity, but I don't have to come in with more cash or restructure my loan. It just is what it is. As long as I make the payment, I can ride that out. But that's not the way Wall Street works. And so rising interest rates is literally a collapse of bond values and the collateral behind all of that. And it creates this cascading effect, a liquidity crisis. And that shows up in Jason's buddies with George Gammon and part of his whole program over there. And George is like the go-to guy when you want to try to understand the repo markets, which I'm not going to get into now because I'm not that smart. I just know that the bond markets will signal the tug of war the Fed has. The Fed is either going to raise rates to try to quell inflation, destroy the bond market, or they're going to try to save the bond market by printing money, which will pour gasoline on the inflation fire. In other words, are they going to save the bond market or are they going to save the dollar? And you have to decide. My bet is they're going to save the bond market and they're going to destroy the dollar. And that's why things like gold, debt on cash flowing investments like real estate, anything real energy is likely to benefit in dollar terms. And so to me, if you want to know what's going on in terms of inflation, you really want to know what's going on and where the risks are, pay attention to the bond market.
I think that's a really great point. Yeah, because the cost of borrowing is huge when it comes to our system, right? I'm sorry, I have somebody at the door and they are pounding it, so I'm just going to ignore them for now.
We all understand that in today's world, Bronson.
I know, it's like this is a Zoom. This is an important call. Let's chat for a minute about affordability, because what happens often is, and this is what I've been thinking about a lot, is as those rates are rising, the person that could afford the $1.2 million house in my neighborhood can no longer afford the same value of a house because the payment is significantly higher. So Jason Hartman, how do you see this kind of going? This is your business, as you do a lot with single family. What do you see happening with values? Will that cause values to fall? What about multifamily or other real estate products? How do you see it kind of going?
As far as the single family, not yet. Of course, there will at some point be a correction. Every market corrects. Every market gets out ahead of itself, out ahead of its skis, so to speak. And then there's a correction and a pullback. There are always market cycles. I mean, the Austrians taught us that, of course, and many others. But I think we're a ways away from that. One of the funny things that I've noticed, and I'm sure Russell can attest to this too, is that people have this kind of unusual linear thinking when it comes to real estate and affordability, housing affordability. And they sort of make these kind of half-baked statements, and I think they believe them too, that are like, well, if interest rates go up and prices are high, then people won't be able to afford a home. Well, what is a home? Please define that for me. The reality of it is that the marketplace is dynamic. And so people out in the marketplace, they're making choices and they're always choosing the best available alternative. We're all familiar with the acronym used in economics and financial circles, TINA, T-I-N-A. And that stands for there is no alternative. And it's not really what it says. It says there's no alternative, but what it really means is people choose the best available alternative, okay? And money flows to the best available alternative. So with traditional owner-occupant home buyers, for example, they simply have to accept less, period. That's it. It's not like they're going to necessarily become homeless or continue to rent. Some of them will. People will make decisions, rent or buy, of course, but they will simply accept less. And this is the insidious thing that inflation does and the whole system does to people. It reduces the standard of living. And so people simply will make trade-offs and they will accept less. I did an example recently in one of my talks at a conference where I picked out a home on Zillow that was for sale in Jacksonville, Florida, for $1 million. And then I picked out another home, if you want to call it that, in New York City that was $1 million. And you went from 5,000 square feet in Jacksonville in this gorgeous palatial estate to 653 square feet in New York City, exact same price. Okay, exact same price. So it would be like moving from Jacksonville to New York City. People simply have to accept less. That's the reality of it. You're not going to get 5,000 square feet in New York City for $1 million. You're going to get 653 square feet. And that's what happens with inflation, with the insidious game that the Federal Reserve has played and the government has played on people with this overspending. People just will have to accept less. Now, that won't happen at the elite end of the spectrum, because those people are being enriched by this. But on the lower end of the socioeconomic spectrum, that's exactly what happens. People will get less for rent. They will get less for purchase. They will just have to accept less. And that's the sad reality of it.
Right. Russ, you look like you're chomping at the bit to say something there, so I want to give you a chance to say something.
Well, I mean, I always have something to say, but I mean, especially about real estate. But I agree with Jason. And the thing is, way back when I did a little bit of research and I took the average interest rate in the 30-year fixed mortgage and I correlated it to the median home price and realized there was really no correlation. Interest rates went up and down and home prices just continually went up. And I think what Jason's opening comment was brilliant in that people make these very simple conclusions, and they sometimes, I think, assume that if interest rates go up, that makes housing less affordable, and yet interest rates are going up for a reason. And the reason they're going up is because of inflation, and they're trying to tame inflation. And so as those interest rates go up, so do wages. Now, they don't go up as much. People are definitely losing purchasing power, but so do the cost of all the materials. And so by definition, the cost of the property, or the value of the property in terms of dollars, is worth more. To get new product out of the ground, you're going to have to pay more, or, to Jason's point, accept less. That's kind of like shrinkflation. So all of that part, makes sense. And then the other part of it is people will move. And so you can have an area like New York where somebody says, well, shoot, for $1 million, I only get 653 square feet. And now in mobile work, I can move to Jacksonville and get 5,000 square feet and no income tax. Why wouldn't I do that? And so the danger that a lot of people have when they kind of get into the macroeconomics of everything, and I'm one of those guys, and I hang around with a lot of those guys, as do Brien and Jason, but they tend to think of real estate like stocks, bonds, commodities, and real estate is just not that. Every piece of real estate is different. Every local market is different. It's just very, very different. So there will be winners and losers. And so it's an interesting thing to talk about. Yes, there are going to be people who are going to lose. There are going to be people that can't afford to get as much. They're going to compromise. Other people are going to be enriched by inflation. They'll have stocks and bigger down payments, and they'll be able to move up. They'll be able to purchase investment property. So there's just really no historical strong correlation between interest rate fluctuations and real estate prices. If you go back and look at it, the trend is pretty solid. The one major anomaly was 2008, and it wasn't so much interest rates that caused the problem. It was a collapse of the credit markets because of what was going on in the mortgage-backed security bond market. And that's a whole different discussion, which I won't open up that can of worms. But the point is, there's not the correlation that a lot of pundits just assume is there and everybody buys because it sounds like it makes sense. In the real world, it's not there.
Right. No, I think there's a lot of oversimplification of this, like you said. And I think that one thing that you both alluded to was the idea of population migration. So we're buying like crazy actually in Jacksonville, Florida right now, because we see growth. I know, Russ, you guys are doing some work there as well. And it's something that people are making the choice to move from certain areas to go to cheaper areas because they can live better, they can work remotely, the weather's better, they're retired, things like that. So it's definitely something to how they're kind of transferring ownership, or just kind of shifting. It can be shifting. But Brien, I wanted to ask you this because this ties in here as well. When we're talking about interest rates and we're talking about interest rates rising, the Fed has publicly said they're going to raise to 1.75 to 2% by the end of the year. There's been some bullish kind of people in the Fed that have said it actually might be, or excuse me, not bullish, more hawkish, that have said they may actually go higher than that. But what do you kind of see as it looking like, and how will that affect, I guess, this conversation as far as looking towards assets and opportunities?
Well, I think if we get into a recession in the next month or two, or really have a significant slowdown, I don't know that they'll do a whole lot. They'll probably slow down, but keep hiking. But yes, if the economy goes into recession, if the stock market tanks, well, you betcha they're going to turn around and quit, because they take their orders from the markets that they created. I don't know if it's an old saying, but once you create a monster, then you have to feed it. And the Fed created a monster in the financial markets by design post 2008, and really even going back further. It's a cycle that's gone for decades, really since Volcker left. But it's progressively eased rates and eased monetary policy for every hiccup in the economy, not even a recession, but any kind of real or imagined slowdown. The recipe has always been the same, to lower rates, but they can never get it back up. There's no such thing as normalization. They've never been able to return it back to where it was before, or even the midpoint of the range before. And post 2008, they had a mission to go out and refloat the financial markets, not just real estate, but also the stock market. And in doing that, they created a new economy. When I started in this business, the better part of 4 decades ago, there was an old saying that the stock market is not the economy. Well, it sure is today. All of these bubbles represent the economy in today's consumer-driven economy in the U.S. So they will not risk that. So one of two things is going to happen during this rate tightening cycle. Either the markets are going to tell the Fed to lay off, which could happen at any time, like maybe tomorrow. It really is to that point. Or when the Fed gets rates up to, or gets the Fed funds rate to about 2%, they're going to have to turn back, because the effect of that will be to send the debt service costs close to $1 trillion every year, swamping every other item in the budget. And I just think that that's not politically acceptable in today's environment. I don't think that Elizabeth Warren is going to sit still for sending $1 trillion to fat cat hedge fund investors in China. And she's going to start talking about, why are we paying this? And there will be some serious talk by unserious people, but still people in positions in Washington, about why are we paying this treasury debt? And when that happens, things will get really kind of squirrely. I think the credibility of the dollar will be severely damaged, and you'll see things again, real assets soar as people look for safe havens.
That's a really great point. You know, the Fed has reverse course before. They've tried to tighten and they didn't. Oh, just kidding. We're going to actually turn it around. So if they actually hold true to it, and obviously it comes at an incredible cost to everyone, but especially their own, the amount of money they have to pay on the debt that the government owes. Let's talk. I want to start with Jason. We'll kind of go around, but what are some of the, I just want to remind everybody that's live, we are going to be having some Q&A at the end. So you can put your questions in the chat. There's actually a Q&A part of the chat, which is kind of to the right of the chat. So you can put your questions in there. We're going to start in a few minutes, start taking some questions, but what sort of opportunities, obviously this is a strategy summit. So what sort of opportunities do you think investors should be looking at specifically? So obviously real estate is one, but real estate, as Russ was saying, is not an asset class. Like what areas of real estate, what sort of property, what sort of things should you look for? What are things that, or if it's gold, what kind of gold, is it gold? Just maybe some very specific recommendations. Obviously there's no, investment advice being given, but just things for people to consider.
Right. Well, I think the basic theme of an inflationary environment is that you want to own stuff, because stuff has intrinsic value. How do you like that for a complex phrase? Stuff, buy stuff. Yeah.
Put that on a t-shirt.
But I mean, really think about that incredibly sort of ridiculous, simplified statement I made, right? Used cars are more expensive used than new now. I mean, that's an amazing thing, right? Normally a new car would always be more expensive, but the fact that you have materials, you have atoms, right? Stuff has intrinsic value. Paper things have questionable value, right? So if you own stuff, the stuff that especially people need and want, right? That is valuable in inflationary times. And throughout history, we've seen this over and over in Weimar Germany, in Zimbabwe, in Hungary, in every inflationary example you can think of throughout history. Once people figured it out, they would always take their currency units, and as soon as they got a hold of them from their job, from their pay, they would exchange those currency units for things, because things had intrinsic value. So I, of course, like income property. I love single family homes. That's my favorite asset class. But things, right? Brien is really a fan of gold, and gold has been considered money for 5,000 years or so. Okay. These are things that have intrinsic value. They don't need to be debased or attacked by any sort of government or central bank. They are things that people just intrinsically need. So, in times of uncertainty, people store food. And what they're really doing is maybe not planning for the end of the world. They're simply hedging food inflation costs, right? By buying food in advance before the price increases. And so own stuff. That is the most simple advice I can give. Stuff matters, as long as it's hopefully not depreciating stuff, and it's stuff that people need. And everybody in the world needs housing. And the ingredients of those houses, the copper wire, the concrete, the steel, the glass, the lumber, of course, we've heard a lot about lumber over the past year, the energy, the petroleum products, every ingredient of a house are commodities that are traded around the world, not attached to any one specific currency. They have intrinsic value. Everybody knows it. Everybody needs it. And so that strategy, I think, is a good one. Just have things, stuff. Stuff matters.
You're muted, buddy.
Yeah. Bronson is muted,
That's
right?
a rookie mistake.
I was having a great
we were all doing lip reading.
I was on my stuff rant,
and I don't repeat myself, so I won't say it again. No, the idea of having, there's a point in every something like this where inflation picks up, where there's a loss of confidence in the currency, right? And people start saying that I need to own something real, and it's starting to happen because people are realizing they're losing $10,000 to $20,000 per 100,000 a year just sitting in the bank. And so it's like, well, what do I need to do with this? So Russ, what are you seeing people should consider?
Debt. I mean, I
Put
think
that on a t-shirt.
I think debt is one of the best things you could have on your balance sheet right now. The whole purpose of inflation is to diminish the burden of debt on an overly indebted world and an overly indebted government. And if you believe that they're going to save the debt markets in favor of the currency, in other words, sacrifice the currency, then Jason's 1,000% right. You want to own things that are real and essential. And we've been preaching that since the great financial crisis. Obviously, real estate fits into that category. Agriculture, which is a derivative, if you will, of real estate, or a different niche in real estate. We've been big proponents of farmland investing, and there's ways to do it. And even within the niche of real estate, affordable housing and affordable markets, or some form of real estate where you're deriving rents from the affluent, people who are actually going to benefit from inflation. We're into resort property. The residential assisted living is a great space because you have affluent people who are doing something real and essential, taking care of an elderly parent. That money's coming in. A lot of times it's backed by insurance. That can be a great space. The short-term rentals is another one where your tenant base are largely affluent people and the tax breaks are great. So within the niche of real estate, there's some places you can play. And then if you're accumulating debt on your balance sheet and being very attentive to managing the cash flows related to that, then you can end up having debt against productive assets. And over time, the other real assets on your balance sheet, whether it's oil or the real estate or precious metals, and I'm even going to throw some crypto in there because I think money is going to go there looking for a haven. And as those things go up, denominated in dollars, the debt that you have denominated in dollars remains fixed. And so you can ultimately retire that debt with the appreciation from those other assets. And so without the debt on your balance sheet, you're not gaining as much against inflation, because if everything goes up, then you're going to keep pace by owning things that are real. But if you buy things that are real with debt and everything goes up, then you get to use the inflation to retire the debt. The debt effectively allows you to short the dollar. Most real estate investors don't understand shorting, but Brien does because he's in a space where that happens all the time. But debt, and the best debt you can get, to Jason's point in his love affair with residential housing, is 30-year fixed. It's the cheapest debt. It's the longest term debt. It's the lowest interest rate debt. And if you go stack up a bunch of that against the right properties in the right markets with good solid cash flows, and then load up a bunch of gold and energy and precious metals and things like that on your balance sheet, somewhere down the road, if the dollar collapses, you're going to be a happy camper. The only other thing I'd say, if you're an American, and I'm guessing most people on this webinar are Americans, you better start to think outside the dollar. Every other country in the world thinks outside the dollar. They think about their local currency and they think about the dollar because the dollar is the world's reserve currency. About a month ago, Jerome Powell came out and said something that I haven't heard anybody make a big deal about. I'm sure Jason saw it and Brien saw it, but he goes, I can kind of see a world where there's more than one world reserve currency. And, now you see the moves that Russia's been making. I've been talking about this ever since the 2013 New Orleans Investment Conference, where I gave a presentation on it. And I chronicled the moves that Russia and China began making in the wake of the great financial crisis to undermine the dollar and its dominant position. Well, you're not going to do that overnight. They've been working on it for a decade. And a lot of those plans are coming to fruition. So if you're an American and you have not been paying attention to this, it's time to wake up and start paying attention and start adjusting your portfolio, not for the inevitable, but for the possibility, or as our friend George Gammon likes to say, the probability that the dollar may end up falling or completely collapsing. And you better have a plan B, at least in your mind, if not on your balance sheet.
So I love that, the idea that you are able to use debt to go buy assets such as productive real estate, you cash flow with it, and you're paying it off with future dollars that are worth less, and it's going to appreciate because there's more dollars in the system. So it's a double positive, right? It's going to be worth more and your debt is worth less. Really incredible. Love it. Brien Lundin, talk to us about what are some things that you're seeing that people should consider in light of everything happening.
Yeah, well, of course, I agree with everything Jason and Russ are saying. And I do believe debt is important, a way to leverage all of this. Russ is the guru of using that strategy, those strategies, particularly in concert with gold and bullion. And of course, I'm the gold guy, so what do you expect me to say here? Well, I'll add silver to the mix too. I really like silver as well. So yeah, I think you should own gold and silver. I think you need to own gold and silver bullion. Don't mess around with modern rarities, modern issue coins. Don't mess around with numismatics or collectible coins. Bullion coins, and it's easy to find out, fairly easy to find out what those mean. But it's big and heavy, and if you have a lot of wealth, if you have a lot of cash, it's hard to put that into bullion and keep it around the house or keep it accessible. So you need to have some portion of your wealth available and in bullion accessible. But if you have more than can be easily stored that you want to guard with, you can use some of the ETFs out there, but you have to be careful which ones. Don't get into the big ones of GLD and SLV. For one thing, we don't really know if they're putting away big bullion bars, if they really have an effect on the physical market. If you go into the Sprott Physical Trust, they're actually buying those bars. And, one of the things I've noticed is that they're saying they're having difficulty getting the big 1,000-ounce silver bars, for instance, for the Sprott Physical Silver Trust. They're having a hard time buying them because they're buying so much right now. You don't hear SLV complaining about how it's hard to find those bars. Ipso facto, maybe they aren't. Maybe they're not out there in the market buying the stuff if they're not having a problem finding it. So I like those bullion trusts that Sprott offers for parking cash and using it as typically a trading vehicle. But it is very important to have the physical metals, a good portion of them in your possession or very near accessibility.
So I want to ask Russ a question tied into this, because I love this strategy that he's come up with called the precious equity strategy, where you buy physical metals and then you can actually access the liquidity from them. Can you talk just a minute, just kind of give a quick discussion about that?
Yeah, I actually taught this on our last investor summit, which is not a pitch because we're already completely sold out with 100 people on the waiting list. It's amazing. But it was really well received. And I've been talking about this actually for quite a while, all the way back to our Future Money and Wealth conference in 2016. And the concept is simple. If you've got a bunch of equity and you know that it is there, it's idle on your balance sheet, you want to do a couple things. One is you want to put it to work. Two is you want to protect it from a market downturn. Three, you want to separate it from the liability of the property itself. How do you do that? You do a big cash out refinance and you pull the equity out. Okay, now you're liquid, but you got a payment. So you got to deal with the payment. Hypothetically, let's say you pull a couple $100,000 out at 4%. And then you take half the proceeds, $100,000, and you put it into a high yield note or a high yield piece of property, something where you feel very confident you're going to get that a yield of 8% or more. And there's plenty of vehicles out there that can do it. Now you have 100% of your payment covered with only 50% of your cash out proceeds, which leaves you $100,000 of liquid cash that is no longer got a payment associated with it. Well, you could take that money and just buy gold, or you could put it into a proper qualified retirement plan and maybe get a tax break. But whether you get tax break putting it in or not, once it's in there, it's very, very safe. I mean, IRAs are safe from all kinds of judgments, and it's one of the best places for, in your balance sheet. You can have assets that are safe from creditors, even the IRS. So you put it in there. Now you've moved your equity from your property where it's exposed to liens and market forces, and you have converted into gold and put it inside your qualified retirement plan. Now, somewhere down the road, if, for example, you needed some liquidity, gold is very liquid. I mean, you can walk into a shop and drop it off. And the thing is, and walk out with cash in a big amount. You can borrow against it, which means you can pledge it as collateral and borrow against it if you wanted to. It's also kind of home base, meaning you can pivot into any currency. We haven't talked too much about Russia, and I mean, kind of what's going on in the world. Everybody wants to talk about Russia, but I think that anybody paying attention saw that when Russia got locked out of the dollar markets, its ruble crashed. Well, you know what? I mean, that would have been a great time. And I'm not a currency trader, but I looked at that and said, I ought to put $100,000 into rubles, because they're the third largest oil producer in the world, and all they have to do is demand payment in rubles, and people are going to pay. And that's sure enough, that's exactly what they did. And I think that in a month, it went from 180 to 1 to the dollar to like 80 to 1. And you would have probably doubled your money just in about 30 days, and that's where a currency is backed by something that's real. So that's a little sidebar. But the point is that there's ways for you to add debt to your balance sheet, convert equity from a less liquid form in real estate and put it into a more liquid form in precious metals, and then isolate it through various asset protection structures. So it's very, very safe from creditors and predators of all types. And these are the types of things that aren't complicated to do, but you're not going to get them from your mainstream paper asset financial planner, because they only know paper assets. And one of the reasons you'd want to do this is because it begins to remove some counterparty risk from your portfolio. And most people have gobs of it in their portfolio and don't even know about it, because of paper asset people never talk about counterparty risk, because their whole system is full of it. So when you get into things, to Jason's point, that are real, when you are the counterparty that owes, meaning you have debt, not the counterparty that needs to be paid, meaning you're the lender. And then when you own cash flowing real estate that are hedged against inflation, because rents and the value of the properties go up over time, and you've built liquidity outside the dollar and the financial system through precious metals, you begin to have a portfolio construction that can weather some pretty stormy seas. And I got a feeling we're going to have some of those in the not too distant future.
Thanks for sharing that, Russ. I think it's a great strategy. It's something that I do as well, where I have physical gold stored at a vault, and then you can borrow against the value of it at a pretty low rate, which is great. I want to take some questions in a minute, but I want to ask Jason one more question about cryptocurrency. So before we do that, if you have a question, just go ahead and put it in the chat under the Q&A part. We'll start taking some questions, and we'll kind of do round robin style when we get in there. So Jason, talk to us about Bitcoin, crypto, and also the central bank digital currencies. Do you think that, and we got a lot of people that are really into crypto and Bitcoin, and even Russ is a real estate guy, right? We're real estate guys, but I've even, turned the corner from thinking, oh, this is kind of a scam, to like, I actually own some Bitcoin now off of the exchange. I feel like I have some, especially the stuff that happened in the Canadian truckers, where they're shutting down people's accounts that actually gave money or support to them, which is just absolutely insane, right? You give to a cause you like, and they shut all your assets down, which is crazy. So talk to us a little bit about what you see happening in that world with Bitcoin, crypto, and central bank digital currencies.
Well, first, just to comment on your trucker statement, I think the world really should be extremely scared when we see a supposedly democratic country like Canada and a frickin' tyrant like Justin Trudeau. I mean, what a complete scumbag. That man should be ashamed of himself. He should be imprisoned. He is a traitor against his own people. It is absolutely unbelievable what happened there. And I think it has shown the world that it could happen here. It has happened here to one degree or another, even on, not too long ago, we had a one of those things where people like cast their opinion about who they want to hold office. I don't even want to say the words, but you know what I'm talking about. And so yeah, it's look, when I originally learned about Bitcoin, that was probably 10 years ago or so. It was $74 per coin. And I just didn't get it for a long time. And I didn't believe it for a long time. And, I still really question whether it will be a success. And here's why. The two most powerful forces the human race has ever known are governments and central banks, unfortunately. I would love nothing more than to see Bitcoin or some other decentralized currency of the people succeed wildly. I think it would be the greatest thing ever for freedom and liberty. But I don't know if that's going to happen because the forces against it are extremely powerful. Now, when it comes to cryptocurrencies, of course, the ones that will take off right away will be the ones forced upon the people. That'll be a digital dollar, a central bank digital currency, whatever it's going to be called. But that will be a success in quotes because it will be forced upon people. And it will probably be ushered in on the heels of a problem with cryptocurrency. Maybe that'll be engineered. Maybe it'll be a false flag. We don't know. They will have to do something to protect us, as they always want to do, supposedly. And we'll see what happens. But I think a central bank digital currency is a extremely scary thing because one of the very important liberties people need to be free is the freedom to spend, and the freedom to spend the way they want and to spend privately so that it cannot be tracked. That is a really important civil right, and a central bank digital currency will end that civil right. I've always said years ago, before cryptocurrencies, I always said that when there is a global fiat currency, it will be checkmate upon humanity. But a central bank digital currency that has the power of a computer network behind it will be even worse because they can put restrictions on it. They can inflate away your money. They can force you to spend it within 30 days of receiving it. It'll probably be ushered in with a universal basic income or some kind of stimulus. And they can say the money doesn't work more than 1 mile from your home or after 10 p.m. at night or before 8 a.m. in the morning. I mean, what they can do is endless, the way they can restrict freedoms. So it's extremely dire that we make sure that doesn't happen because spending is a really important civil right and the ability to spend freely and privately.
All right. Well, thank you for that. We're going to move at this time to some questions. We've got a few minutes to take a few questions. We have some questions in the box here. So if you have a question, feel free to put it in there. Just a reminder, this will be sent out as a replay later. So if you wanted to watch it or forward it to somebody else, you can feel free to do that.
Hey, Bronson.
Yes.
Sorry about this, buddy.
Ahead,
but
sure.
Since Jason went there, and I'm so glad you did, I just want to make one point and give people something to think about. Most people want to get rich because they want to be free. And they think riches precedes freedom. The opposite is true. Freedom precedes riches. Our founding fathers set us free. We became rich. Our current leadership is making us less free. We are collectively becoming poorer, and the world is becoming poorer. I don't care how rich you are. Look at Jack Ma in China, right? He's the Jeff Bezos. He's the founder of Alibaba, which is the Amazon of China. One of the richest guys in the world. But he talked out of school about the Communist Party, the Chinese Communist Party, and then he kind of just disappeared and came out a very humbled man. His wealth did not make him free. If we don't preserve freedom in our country, there's no riches that are worth having. And so Jason kind of went there. I just thought I'd put a little bit of an exclamation point on it, because if we don't all stand together and fight for our freedom, not just our individual personal financial freedom, which again doesn't mean anything if we lose real freedom in these United States. And where are you going to go? You know, Ronald Reagan said it way back when. If we lose it here, where are you going to go? Like, we're involved offshore. And, I originally got into that because I wanted to have a bug out place, but I got kids, I got grandkids. No, I'm not intending to leave. I'm intending to stand here and make a stand. So I just encourage everybody to consider very carefully when you are seeking your own financial freedom to understand the important role of using some of that wealth to actually protect the freedom that allows you to be rich in the first place.
That's a great comment. Thank you for that, both of you. Thank you so much. Question here. This one's to Brien. What degree of significance do you put on, and we mentioned this earlier, Putin backing the ruble with gold and oil? Do you feel this is a real step toward the loss of currency, reserve currency status in the U.S.?
I have a not too popular opinion in this gold universe about that. I don't really think it's a big deal. It was a big deal for the ruble, at least in the short term, because it helped stabilize it. And Russia is smart. Russia's central bank chairwoman is brilliant. Naberlina is the one who sold all of the U.S. treasuries out of the Russian reserves and bought gold instead, which put them in much better stead right now. But until, it's not really a gold standard, until the Russian central bank, if you go up to their front doors, if you could get there today, with a bunch of rubles and give them those rubles and ask for gold, and they give it to you, until that happens, it's not a real gold standard. But it is a wonderful way and a brilliant way that they've done at this point to kind of play the markets. And basically, they're saying, if you have gold, we'll buy it from you with these rubles that we're printing up in the back room here. And they've been doing that for years. It has been the law in Russia that countries mining gold in Russia have to sell the gold to the central bank. And then they take rubles in exchange for that. So they're printing up rubles for nothing and getting gold in return. So that's a wonderful trade for them. And it's really just kind of continuing that and setting a standard price right now instead of the world price, which has served to somewhat stabilize the ruble against the world currencies right now. But it's not a true gold standard or a linking of gold to the ruble just yet.
Thank you for that. Anybody else have any comment on that, or should we go to the next question?
Well, Brian, what about the petro? What about the oil side of it? Russia's the third largest exporter of oil. They're a huge exporter of natural gas, and Europe is very dependent upon that supply chain of gas. They came out and said, hey, they demanded rubles. So to me, it's less about gold and their currency as being a threat to the dollar as it is energy. Because there's already, I think the bigger picture, Bronson, and I'd be interested to hear what you have to say, Brian, and you too, Jason, for that matter, is that the world has been put on notice that the world's reserve currency is not neutral. It's politicized, it's weaponized. And if you cross the United States, you're going to get locked out of that. And so if that turns out to be the case, then we've already seen the dollar in terms of its percentage of world trade drop from somewhere in the 80 percentile down to the low 60s. That's a pretty substantial drop. And events like this create a lot of incentive for countries to create bilateral trade agreements, to trade outside the dollar, to maybe begin to store wealth in something outside the dollar. When they see if they fall into the crosshairs of the United States, their dollar assets can be frozen, can be seized. They've attempted to lock Russia out of the gold market and their ability to sell gold on the open market to raise dollars to pay bills. They just had to make a big debt payment using rubles because they were locked out of the dollar system. So, Brian, what do you think in terms of that? Not that's not really the gold back thing. That's just, hey, demand for a currency other than dollars for international currency by a lot of players, especially when it's driven by a country that has such big energy reserves.
Yeah, I think that's the real strong hand that Russia has to play. They're talking about banning Russian coal exports and oil exports, but they need the gas, so they're going to exclude that. So it's a matter of a Mexican standoff. But from the Russian standpoint, it's kind of cutting off their nose to spite their face because they need the dollars. They don't need rubles. They really need the dollars. So once they do that, then they're going to kind of stem the flow of the dollars that they really need.
But
it's going to be interesting.
When they demand rubles, people are going to have to buy those rubles, and presumably they're going to buy them with dollars, so they're going to get the dollars anyway.
it's going to strengthen the ruble. That's the end result, and that does serve a purpose for them. But they also need to be able to pay their bond payments in dollars as well. So that's, there's a yin and a yang to both sides to this. It will be interesting to see how they play it out. I think that a lot of this was working towards Russia's favor. They're kind of waiting out the markets before Bucha and what happened there. And I think that that's kind of firmed the resolve of some of these governments. They're kind of embarrassed now to do any business with Russia. But Germany has gotten itself in quite a pickle. Whether it can get through without Russian gas, it just seems doubtful that they will be able to do that. So they're always, I think, going to have to eventually kowtow to whatever Russia says in terms of the gas imports.
The first thing I thought of when I read about Putin demanding rubles for oil is I thought, Putin is basically invoking modern monetary theory. He's increasing the demand for his own currency. And I thought that was a pretty brilliant move. I think it's a terrible move that he invaded Ukraine in the first place. It's absolutely horrific what's happened. But that was a pretty smart move on the part of the ruble thing. You guys agree with that, right? I'm guessing on his part.
Well, they've been preparing for this for a long time.
Yeah.
Selling the treasuries, stockpiling gold,
right.
Getting into bilateral. They were the very first one to sign a bilateral trade agreement with China back in 2010.
Yeah.
And so they've formed alliances with people who can consume their products and services, and they're tight. We've driven largely Russia into the arms of China. So you got this giant population, this giant manufacturing economy, and then you've got this big energy producer, and those two together are pretty formidable on the world stage, and they're both anti-dollar.
Yeah, and I agree with you today about that. But I just don't buy into this theory about China being as big a deal as everybody's making. What they've done is obviously incredible over the last 30 years, but in 10 years, China has a demographic time bomb that is going to start exploding. And after 10 years from now, it is going to just get worse and worse and worse for them. Russia is a dying country. The old saying, demographics is destiny, right? And that almost every competitor, if you will, of the U.S., every major competitor has giant demographic problems. Western Europe is a dying continent. Russia's a dying country. Japan's a dying country. And China will be a dying country soon. If you don't have kids, you can't have a country.
Yeah, and by that measure, Africa will rule the world in 30, 40 years. There's a lot of talk about the dollar losing its reserve currency status and losing it to China. And I don't think that'll ever happen because, simply put, rule of law. The U.S. has, in my view, lousy rule of law, but it's still the best around.
It's better than elsewhere.
The value of the dollar doesn't depend on which side of the bed Chairman Xi woke up on that morning. So I think that combined with aircraft carriers will keep the dollar as a reserve currency.
I always say that about aircraft carriers. 12 aircraft carriers say the dollar is backed as the reserve currency of the world. Yeah,
that's great. No, I appreciate you guys sharing. That's awesome. I felt that some of the recent moves with, and I'm not a fan of. I think none of us are a fan of what's happening in Ukraine. But the idea of all the sanctions are pushing Russia and China, some of these groups closer together and away from the dollar. And so it's having some negative, I think it will have some negative effects for the dollar as well. Let's get into a couple questions here. I have one, actually, this one is probably, I'd love Jason to answer this one. This is from Jackie. He says, the interest rate is higher and higher, which makes leveraged properties cash flow almost next to none. A lot of people are buying properties and turning them into Airbnb for better cash flow now. How will it look in the near future where short-term rentals anywhere? Is there any negative effect that you can see as far as Airbnb?
Yeah, that's a really interesting idea. And one of my podcast listeners and friends did an interesting study in one city looking at all of the Airbnb units available. and the what if scenario if those properties were to come up for sale. So, we've got to remember something about the Airbnb thing. Airbnb is a baby. It's really only been around prominently for about 12 years. I mean, it was there a little bit before that, but it was nothing. And it's interesting. The population has increased a bit, but during that time, but not that much. And more hotels have been built. I mean, the number of beds outside of someone's primary residence has increased quite dramatically. Look at all these mattress companies, they're popping up out of the woodwork, right? You got Casper and Tuft and Needle, and whatever happened to Beauty Rest and all those Simmons and all the old ones, right? So there's a lot of beds available around the world, and I think there's a lot of extra supply. And if the economy goes into a major recession, or when it does, the first thing people cut out is travel and vacations. That's not a necessity. Now, some of the Airbnb market is for people like traveling nurses and, people on job assignments and so forth. I get it. But it just seems like there's a potential for a real oversupply issue here. It's hard to measure, but that's just my feeling anecdotally.
Thank you. We've got time for one more question here. I'd love to just kind of put this around to the group. As far as if somebody has, again, this is no specific advice, obviously consult your own professional, legal, tax person, all that stuff. But for 401k accounts, investing, in real estate, is that a good choice to use a real estate account, or what type of account would you recommend to use for your real estate or other assets, I should say, if you want to get your retirement funds into different types of assets?
Who are you tossing it to?
I'll toss it to you, Russ, since you spoke up first.
Well, I think the thing about retirement accounts is they're tax advantaged. And so when you look at real estate has some real tax advantages, but you don't need them when you put them in a retirement account. And worse, if you're using the other huge advantage of real estate, which is leverage, it creates some real problems with unearned business tax, with the profits, the prorated profit that you derive from the debt being taxable outside of the retirement account. So it actually backfires on you a little bit in terms of the tax. So I'm not a fan of typically using retirement account money for traditional real estate, like where you're going to make a down payment and get a loan. If you want to use it to make a passive investment in like a limited liability company and a passive, buying shares in a private placement for an apartment complex or something like that, that might not be a bad idea. Again, just make sure that however that's being reported to you, if you're receiving tax breaks in the pass-through, make sure you are dealing with an accountant who really understands the ramifications of that. However, I think it's a great idea to get whatever assets you have in any accounts out of the paper asset world, which are really volatile, and get them into things that are real. And I go back to saying real estate, residential real estate, affordable residential real estate in the right markets, precious metals, agriculture, energy, commodities of various types. I think all those things can make a lot of sense in a retirement account, because if you get hyperinflation, those commodities are going to go way up in dollar denominated terms. If you have them in a tax sheltered vehicle, you don't have to worry about the tax consequences on that capital gain, which we could do a whole thing on the impact of taxes on inflation wealth. But that's, I think, in simple terms, that's how I look at retirement accounts. You're muted.
Thank you. I guess I like talking to myself. Wanted to thank each of you gentlemen. We're going to just take a quick pause, and then we're going to come back and share some information. So in the chat, I just put in, actually, I think I put it in the Q&A, so I'll put it back in the chat. We do have another event coming up that's going to be talking about multifamily and what is changing. So it's on May 4th at 4 p.m. I wanted to just do a screen share real quick just to show it, because we had a little technical issue earlier in how to do this. Are you guys able to see this?
Yes.
Okay, great. So this is the next event coming up on May 4th, and it's at 4 p.m. And we've got Michael Becker, Ferris Musa, and Brad Sumrock coming on to talk about the different changes that are happening. So I just wanted to share that with you. So if you want to sign up for that now, we'll have another great conversation like this. Wanted to really say thank you to each of our panelists for coming on. I have tremendous respect for each of these guys. And if you're not following all of them, I suggest before you do anything else, you get on their website, you search them online, you follow them, because they are really providing content that is absolutely cutting edge. So they all have live events. They all have things that they're doing. They all have products and services that they do. So please, please, please check them out. Support this as well. So I just wanted to say thank you to also our attendees for joining, or if you're watching on a replay, we always say the best education, or the best investment, excuse me, is really in your own education. So that's what you did today. So well done on that. But I just want to say thank you for everyone. Again, this replay will be sent out shortly afterwards. If we had more time, we'd spend hours going through all this stuff. That's why you got to check these guys out online and come to some live events as well. So thanks again, everyone. Thanks to our panelists, and we'll look forward to seeing you guys at the next one.
Thank you.
Thanks so much.
Bronson.
Okay. Thanks.